Welcome back to the Real Estate Talk Show, your source for all things real estate. All right, how many of you have done your taxes? How many of you have done your taxes on time? Well, we have somebody here that's going to give us great tips and advice regarding taxes. We have Gerry Arnini, and he is a partner with Arnini Stellato Chartered Accountants. And boy, oh boy, you know what? It is tax time. He's so busy that we had to come and visit him at his gorgeous office. So thank you for having us.
Thanks for coming. Good to see you again.
We've invaded your space. You have a beautiful boardroom, I have to tell you. I'm kind of liking it here.
You'll take for the rest of the day. Have everyone come in.
All right, so let's get down to business here. There was a great article, and it's talking about love and taxes. I kind of like the header of that. Love and taxes. You don't really put the two together, Gerry. No. In fact, usually it can cause...
hate and taxes.
What do they say? There's two guarantees in life? Death and taxes, right?
Correct.
All right. Well, this one is talking in the article about Canadians confused on how marital status impacts deductions. And I think people also think that what happens in the States somewhat applies here, because they seem to talk a lot more about their taxes south of the border. It's just common discussion.
Yeah, you're right.
And here we don't really want to talk about it.
No, and you see more. Our channels are mainly U.S. channels, so that's what you see most of the time.
All right, so let's talk about, I still can't believe it, but love and taxes. So what should we understand then when we are, because of course we could be married or we could be living together.
Correct.
And as a result, there are advantages that couples can take that can benefit in terms of taxes. So can we touch upon those a little bit?
Sure. So basically, obviously, if you're married, you're going to file, everyone files their own tax return.
Okay, that's important.
So,
in the States, important. They don't, though. They file as a couple.
Correct. Years ago, you could do that here as well, but they've changed a lot of our credits. So a lot of the money you get into tax credits. So everyone has to file their own tax returns. Right. So all spouses file their returns, and basically, the returns get linked by Revenue Canada. So you're filing separately, but all the information is linked. So if you're married, obviously, you record that you're married on your tax return. If you're common law, you're automatically, I guess, filing jointly or together or linked if you're together for 12 months or more, or if you declare it earlier. You get together and you just declare that on your personal tax.
Okay, so very important that you have to disclose accurately your status.
Correct.
What defines a marital status? So it's just you have to have that piece of paper?
Not necessarily. Like I said, for when you're married, you have that piece of paper. When you're common law, it's 12 months
of cohabitating.
Cohabitation, right? And or if you declare it sooner. So if you're together and you know you're going to be together, you can just file your tax returns as common law partners. Okay,
so what advantage do people that are married or common law have over those that are single?
Well, there's certain tax credits that you can receive. So basically, if one of the spouses doesn't earn more than $11,000 a year, the spouse that's working can get a tax credit for the person staying home. If there's children, there's certain child or family benefits. So there's benefits in terms of tax credits, not in terms of saving tax on a tax rate. Except for what they've done now with this income splitting, and we can get into that later. But,
now, what happens in Gerry when, let's say, one of the partners or the significant other doesn't work, and that's a choice? So they don't have an income coming in. They still have to file?
They do. Even if you have, basically, if you have a child, there's the universal child tax credit, which is $100 a month per child. So you'd want to file to be able to receive that. Okay, so everyone should really file. If you don't file, if you have no income, there's no requirement to file unless Revenue Canada demands you file the tax return.
And whatever Revenue Canada demands, you do.
Exactly.
Okay, so let's talk about income splitting. How does that work?
We've had for a while pension splitting, income splitting, and that's where retired couples can split pension income to benefit them on a tax basis.
Okay.
Now they've introduced income splitting for families, and basically if one of the spouses is at home and one of the prerequisites is that you have a child that's under 18 years of age, you can split income with your spouse. So if you have one spouse that's making no income at home with a child and another spouse working, you can split up to $50,000 worth of that other spouse's income.
So for example,
the non-working spouse.
You and I are married.
Correct.
And I am making $100,000. You're at home with the kids.
Correct.
So I can take 50,000 of that and put that as your income.
Correct.
Maximum.
And what you get maximum is what's called you get a $2,000 non-refundable tax credit. Okay? So that's the maximum that you'll be able to get.
And this is new.
This is new.
Okay, this is something that now can be taken advantage of.
Correct.
All right, very good. So how about divorce?
How about divorce?
What happens?
Now we're divorced?
I mean,
We're just married, now we're divorced.
It's so clear, right? Well, that's kind of what happens, isn't it? It seems to be out there. There's a lot of divorces.
Yep.
Unfortunately.
There is.
Now what happens? Do you get to file single right away?
You never go back to single status.
Is that right?
No.
Once married, you're kind of always
Well,
considered...
you're going to be divorced. So your
you
status...
are now labeled as divorced.
That's right. And if you pass away, you're labeled as deceased, and
'Cause
your
there's that
surviving
death
spouse
tax.
is labeled as widow.
Right.
Okay, so there's all
like
sorts
any
of,
of
I know,
this.
there's all sorts of little things. You can't go back to filing as single, you just go back to filing
So
as
you
divorced.
will forever be known as divorced.
Correct.
Very good.
Unless you get married again.
Right, that's a whole other subject. So when you are divorced, is there a time frame? Do you have to have something proving you're divorced? Do you still have to, we know that you already submit your taxes individually, but let's say there's, not a smooth process in this divorce, and there's some arguments and discrepancies and this and that. So
Well,
what
basically,
happens?
when in the process, I mean, if you're going through legal or whatever, a person moves out, and that's pretty much will be the date of separation when that person moves out, or if there's some sort of agreement with the lawyers that this is the date of separation.
All right.
Okay, and that's the date you put on your tax return.
All right, very good.
So you can, if it happens partway through the year, you can take advantage of some of the credits partway through the year, and then after that, no. So you're done.
Okay, Gerry, there's lots to know, and the rules change. And it's very important that we get our taxes done, and we get them done on a timely basis. So is it common theme now where people are just rushing to get them done and they're not getting them done in time? I mean, Revenue Canada and the government must be making so much money on penalties, because I know even people I talk with, it's just getting everything. Some people are trying to do it on their own. There's just way too much to know. They go and do those services that do your taxes, but could they be missing credits and opportunities? That's why using somebody like yourself and your firm, Arnini Stellato, to help with this process. You're working for the client, yes?
Correct. So what happens is if you're going to someplace in a mall or whatever, you just show up with slips. That's all they're going to enter on your tax return.
They don't dig deeper.
They don't
ask
dig
specific
deeper.
questions.
It's just, you know what, you brought me 2 slips, I'm going to do your tax return, I'm filing it. Because the onus is on the taxpayer, not on the preparer. So going back to your penalties, in that vein, Revenue Canada now has penalties if you don't file slips. So let's say you do go to the mall and you bring the fellow 2 slips and you're missing one, and he files the tax return or she files the tax return. Revenue Canada, they get copies of T4s, T5s, T3s, so they know what you've been issued. If they don't see it on your tax return, it's no longer, the penalty is no longer the tax you owe on that. It is now 10% of the value of the slip. So
Are you kidding?
no. So if you miss a $10,000 slip for interest, let's say, the automatic penalty is $1,000. So it's important to have your slips. It's important when we do tax returns here, we have a long relationship with our clients. We track what slips were on last year's tax return to what was brought in this current year. And if there's anything missing, we contact the client and say, look, last year you had a slip from this bank and we don't see one this year. Can you call the bank and confirm that there is no slip, or tell us if you closed the account last year? So we do have to do that as part of our service. Then there's other tax credits and other things that you have to keep track of in the long term that may benefit taxpayers in the future. So
even things like depreciation, Gerry, and year over year, and what you did the year before, if the status has changed, even where there be marital or where you live or how you're employed, you'll know what to do for the following years, how to take advantage of that. So really, you save people a lot of money, but also a lot of time.
we do. We save them headaches, as I said. If you don't file or you miss slips, at least we're on top of it. We keep track of all of your carry forward numbers, any losses carry forward, lifetime capital gain exemptions, all these things that really, when you're doing your tax returns yourself or you're going somewhere else, they're not going to be kept track of properly, right? Now, having said that, if your tax return is very, very simple, just a T4 every year, then you know what, you'll probably get away with it. If you have anything challenging, like any real estate or any other investments or whatnot, it's best to go to a professional. Yeah,
So we cause our headaches. You cure them.
we try.
All right, everybody, we're going to be right back with Gerry Arnini. We're going to actually talk about some of those myths around taxes that seem to mislead Canadians. So we'll be right back.